discussing long options and management techniques of long calls, buying calls, speculating on a market movement, or buying puts, we know we have three basic outcomes. All right, number one, the underlying is going to move in our desired direction in our desired time frame, and that's going to lead us to a profit. We're in a long call and the stock moves up. First 20 to 30 days we're in the trade. If maybe you bought a 3-month out or 4-month out call, we're going to see some profit in the position. Maybe you're trading shorter term long options, buying calls or puts with only 15 to 20 days out, maybe even shorter term, speculating with the weeklies on a quick move as well. Now, the stock stagnates is another outcome. We entered a position, we were bullish or bearish on it, we entered into that leveraged call or that leveraged put to sort of maximize our cost basis into the position, but the stock hasn't moved in maybe the first 10, 15, or 20 days. We're losing time value that we paid into the position, again, depending on how far out we bought our options, speculating on the movement of the position. And we're going to look to, of course, adjust it at that time to help mitigate the time value. Now, of course, the main problem is the underlying moves in the opposite direction. Now, there will be a case, and I had essentially one today. I'm in a married put, a protected stock position that has a risk of about 8% on it, and the stock collapsed over 30% today just due to poor earnings, dropped about 10 points on a $40 stock. So in the cases of the large gap, we'll talk about that as well, management techniques for those. But in general, we're going to look, of course, to manage the position before we get to that, or hopefully to avoid that large gap down in price as well. But the underlying moves in the opposite direction, we're seeing a loss on our position. There are ways to manage that, of course, as well. Before we discuss about the specific management techniques, we want to talk about the exit strategies and triggers. You always want to have your trading plan in place when you enter the long option, long call or long put. You want to have your triggers and your exit strategies in place for all three scenarios. So let's say that the underlying has moved in our desired direction. What do we want to do? Well, we want to have that trading plan in place. We're going to look to reduce or remove the cost basis for less exposure. Okay, we can do that a number of ways. And we also don't want to let greed get control. It is very tempting in a lot of cases. And there's nothing wrong with this if you're right most of the time. But in a lot of cases, if I buy a call or a put and I realize a 25 to 30% gain within the first 10 days, my first thought, of course, is to add more calls. I think the stock's going to continue up. It's not a bad approach if you're right. But there's another way that we feel is a little bit better to manage it in that case to still realize the further upside, but also not to take too much risk in the position and continue to add into the debit of the position. So if it reverses, you suffer more of a loss and you don't take advantage of that gain as well. So when I open a long call or a long put, I set my triggers for the target. Okay, so it might be a 33% gain depending on the position. If I'm looking to be more conservative and I'm looking at a stock, let's say trading at 160, and I buy a deep in the money 140 call, well, I know that I might have paid as much as $20 to $25, maybe more for that call. So expecting a 50% gain, seeing it go up to maybe $35 or $40 can happen if I pick the right stock over time. But in general, I'll look to manage or try to lock in some of the gain when I see that first 33% gain, maybe a 50% gain. And of course, if the stock just gaps up on us and we're lucky and we have a 100% gain, there's a lot of things we can do on the position to remove the entire cost basis of the call, but still realize more upside as the stock continues to gain. Other triggers that you might want to use, looking to manage the position, if it goes in your desired direction, up for a long call, down for a long put, is the technicals and fundamentals. Okay, so if the stock's hitting new highs, I'm in a long call, or if it's hitting new lows, for example, in the long put position, but if the stock's hitting new highs and I feel it might recover, there's something, or I'm sorry, it might pull back, there's something that I might want to do in that case to try to lock in the upward gains. Same with the long put. If the stock's hitting new lows and I feel it might bounce back, it might be hitting buy target prices for people who've shorted the stock, investors who've shorted the stock, for example, I may want to take a different adjustment tactic as well. Volume decrease is important. If you're in a long call and you're seeing your stock move up, but you notice that the average volume is declining, that might be a concern. That might be something that's looking at a pullback, so you may want to manage it at that time to try to lock in that gains or reduce your exposure on the long option. And a lot of times you might see hesitation after a breakout. And typically what we look at there is if a stock has gapped above the upper Bollinger Band or suddenly gapped below the lower Bollinger Band on a decrease or a gap down, well, it may in the case of the gap up, it may start to revert back and come closer to the 20-day moving average before the breakout continues. We may want to manage it before we give up some of that long gain in the position as well. And what are some of the triggers you might use as well for things such as the Greeks? Well, delta is probably the most important one that I see used by long option investors. I may have entered into an option slightly out of the money, speculating on a rise or fall in the stock or the underlying security. I may have started off with a delta of, let's say, 0.3 or 0.4. Now, if the stock moves up, my option now becomes in the money, and my delta goes to 0.6 or 0.8. We've doubled the delta. You may want to look to add some positions to your current long call or long put position in that case to help you get to a delta neutral and to help hedge that particular gain you have in the underlying option as well. Another one to consider, as of course the stock moves up in price if I'm in a long call, or it moves down in price if you're in a long put, and your delta is increasing and it's getting closer to 1. What's also happening at that point is your time value is going to 0. As you get closer to a delta of 1 and your option is going deeper in the money, your time value, extrinsic value, is disappearing. Your option is mainly all intrinsic value. Well, you still have potential for upside gain, but at this point your theta is going to 0, so you're not going to experience a lot of time decay remaining in that deep in the money option. That's a good thing. But you want to make sure that you take advantage of the gain that you have in that position at that time, so that could be another trigger. To be honest with you, I don't use the theta going to 0 or dropping 50% as much. I do tend to focus mostly on the delta as well. I don't do gamma hedging myself or gamma scalping. That's more of a neutral position, and it's more of a sort of a conservative, active trader position. We're just talking about long calls and long puts looking to go forward in time and speculating on an increase in price as well. Now, what about if the underlying moves in your desired direction? What kind of triggers would you look for first to manage the position? Now, if possible, and as I mentioned before, it's not always the case. The position I'm in now is a protected stock, but if I did it as a long call and it dropped 30% today, I would have lost nearly 97% of what I invested in the long call position. My put probably would have a 300% gain if it was by itself, but the long call itself would have a loss of almost 100%. We'll talk about that later on as well, what happens when you get that loss above 85 or 90% on the position. But when I'm just trading a long call or a long put, I usually set my target stop at about 33%. I put 50% in here as well for two reasons. Why is it one or the other? Well, I approach it in two different ways depending on how I set up my original position. Again, let's say we had a stock trading at 160, and I bought a slightly in the money, maybe 155 call option. So I paid into about 5 points of intrinsic value, maybe 4 or 5 points of time value, maybe a $10 option. Okay. Well, at that point, if I have intrinsic value and I'm using an in-the-money call, I'd probably set my stop at around 33% loss, okay? Because for that to happen, it's got to lose the time value, the extrinsic value, and it's got to lose some of the intrinsic value. A lot of you may be buying stock right now. You might be just trading long stock positions. You're looking to get into options, and you think long options are a good way to go for your account size and your risk tolerance. That's great. But when you're buying stock, you probably have heard many things about you want to set your stop at around 7 or 8% or so you don't take a larger loss than 7 or 8% on your long stock position. Why am I not setting that on a long call or a long put? Well, the reason why is because as soon as I open the position, let's say I did buy that call that we were talking about, that 155 call for about $10 even. Well, a 7% loss on that position would be if the stock was down, let's say, or the option was down 70 cents or so. So where's the issue? The issue is that if I bought at 10, the bid price might be at 9.30. The bid might be at 9.30. The ask might have been at 10.40, so I got in at about $10. Not a favorable bid-ask spread, but I got in at $10. But right now, the option bid, if I sold to close it, is at 9.30. I might get that 7 to 8% trigger on the leverage call as soon as I open the position. So you have to give a little bit more leeway. We never want to take a 33 or 40 or 50% loss on our transactions. I know that. But at the same time, if you're trying to use a contingent order on the value of your option, you can't set that too close because you'll just get closed out of every position. You're not allowing enough time to run. So with these leveraged options, long calls and long puts, we have to allow a little bit more leeway. Some of our customers use a 25% loss, and that's good too. It's trying to mitigate it a little bit more. But if I'm in a lower price stock, say a $50 stock, and I paid $3 for a long call, and the stock has a 1-point drop today just because of some basic bad news, I might see my option drop as much as 30%. So I'm already closed out if I set a stop at 20 or at 25%. So that's something you have to be concerned with. You have to be realistic in where you set your contingent orders or your mental stops when doing a long call or a long put. Now, in the case of a loss, the trend is your friend, meaning you probably got into a long call because the stock was trading above the 20-day or the 50-day moving average. Maybe your 50-day moving average was above the 100-day. So a good trigger to use if I'm in a long call, for example, if that trend reverses. If I opened a long call using a technical indicator where I only wanted to find positions where the stock was trading above the 20-day moving average, and now the stock has dropped below the 20-day moving average and seems to be dropping below it further, maybe 2 or 3 days below the 20-day moving average, that's when I might look to manage that long call. And of course, reverse with a long put. If I used MACD, for example, and I looked for a crossover where the MACD had dropped below the signal line, and now it's come back up, and the MACD is a crossover where it's going above the signal line, I may look to manage that long put then before the stock takes off and I end up with a large loss on the position. Okay, so anything that you used as a technical indicator to enter the position, if that reverses, that might be one of your triggers to manage. And of course, we talked about delta before. We want to see the delta double in the case of a gain, perhaps that might be one of your triggers, but another trigger would be the opposite. If I opened a long call or a long put and my delta was at 0.6 or negative 0.6 for the put, but the stock has gone in the opposite direction, my option is now becoming out of the money and my delta drops below 0.3, 50% of what it was, then I may look to manage the position before I take further losses. In addition to that, I know some of you, some of my customers as well, power options customers, will, if they buy an in-the-money option, let's say with a delta of 0.7 or maybe even a high delta of 0.8 for a call or negative 0.8 for the put, they'll never let the delta get to 0.5. As soon as the delta gets to 0.5, they're either liquidating the position or they're trying to adjust it to get back to a favorable delta, depending on which direction they think the stock's going to go. And of course, we also talked about the probability, percent probability above. So with an in-the-money option, I might have a 60 or 70% probability the stock would stay above that strike price, or maybe a 60 or 55% probability the stock would be above the break-even in the next 30 to 60 days. Well, if that probability drops below 50% or below 40%, I may look to manage that call or that put before, again, taking larger losses as well. Oh, sorry, folks. Okay, and then something happened here. I'm sorry, one of my slides didn't save. It's all right. But the triggers for stagnation. Okay, that didn't come up here. But the main triggers that I would use for a stagnating stock, the third outcome, we got into a long call or long put. We're sitting on the position. We haven't seen any movement. Well, number one is time. Okay, and I'll get this fixed here and I'll post it back up later. But time is the main key in that situation. So if I open an option, and in general my long calls or long puts are 3 months to 4 months out in time, usually about 100 days, 90 days to 120 days out in time, looking to at least cross maybe one earnings, but also speculating on growth in the stock for performance and technical indicators as well. However, if I'm in the position for 20 to 30 days, usually about 15 to 20 days, and the stock has not moved by more than 1%, or even if it's dropped and then come back up, but I haven't seen more of a gain of 1% or so on the stock, then I'm going to look to manage the position. And in addition to that, if you're using shorter term options, so let's say that you're trying to speculate with long calls or long puts using weekly series and only 5 or 8 days out in time, well then in that case what you're going to look to do is maybe 1/4 to 1/5 of the time. So if I had 20 days out, I bought a call that's 20 or 21 days out, in the first 4 or 5 days, if I haven't seen the stock move at all, I may consider a management technique to try to reduce my cost and reduce my exposure into the position at the same time. So that general rule there, maybe 1/4 to 1/5 of the time, if you haven't seen the stock move or give you any indication that it's going in your desired direction, we may look to manage it as well. All right, so what are the management techniques? We're going to take a look at a broad basic view. These aren't all of the management techniques that you can use, but these are some of the ones that we want to discuss. Okay, so management techniques if you have a gain in the underlying security. Well, the first is liquidate the position. You've met your goals. The position has been met. There might be more room for upside, but we could just liquidate the position. We did what we wanted to do with this trade. We've got our gain. Let's liquidate the position and look for new options potentially as well going forward. A good rule of thumb, let's say that we've opened 5 contracts or even 10 contracts of a long call or long put position. The stock has gone in our desired direction. A good idea is to close half of the position. So if I had 10 contracts and I have a 50 to 100% gain in that particular call or put, I may sell half of it. This might take out all of the cost basis on the position. I have no more risk and no more exposure. And now we can still have further upside potential by just leaving a position open that has a no cost basis in it as well. How could we increase profits? Well, we could sell half as before, and then we could use the profits to buy the opposite transaction. I bought a call, a 150 strike call when the stock was at 165. It's now trading at 180 or 190. I've got about a 100% gain in that long call position, but I think that it's peaked out. It's hit the top of the mark. So I can sell half of those long calls and then use the profits to buy 4 or 5 put options that are maybe slightly in the money or slightly out of the money right now. So if the stock pulls back from this new high that's given me the gain in my stock, then I can realize a gain on the put as well. You're sort of creating an in-the-money long strangle at that time. Now, another idea, especially if you're still bullish on the position, is to take your gain, sell half of them. Even if you have 4 contracts, sell 2. If you have 2 contracts, maybe sell 1, but use the profits to buy an out-of-the-money option at a higher strike price of the same security, meaning a call. So we had our 150 call. The stock moves up to 190 or so. We've got close to 100% gain. We sell half of our 10 contracts. We have the profits, so we've reduced the cost basis of our remaining 5. And now maybe we look at a 200 or a 210 call, probably a 210 or a 215 call that's further out of the money and a lower cost. So maybe we take half of those profits, and that's a good rule of thumb, take half of the profits that you just got from closing half of your position, use that to buy some out-of-the-money options, and now if the stock continues to do up, you've kind of done what's called laddering. Okay, you've reduced your exposure, you added some of it back in by buying that further out of the money. If it pulls back, well, you could lose on that out-of-the-money long call, but you still took in the profit from the original call, and again, as it reverses, then we'd look to manage it with the decline. And same thing with the put, of course. The stock drops as we wanted, sell half of our position, buy some out-of-the-money puts, and then, of course, if its stock starts to recover, we'll look to adjust those positions as well. Now, one of the other things is if we think in the same scenario, the stock has moved up in the long call as we wanted to, and we think it's peaked out, maybe it's hit that new 52-week high, and we think it's going to pull back a little bit, one of the most popular things to do is just sell a near-term option against it of the same security. So I'm in a long call, I have some profit, I think the stock's going to stagnate where it is now, it's had its gain, I think it's going to pull back. Well, I may sell a call against it, sort of create a calendar spread. I want to be nearer term with the short call as well. And then another idea, of course, many of you might have seen this with the radioactive trading techniques, we can treat a long call the same way. If the stock has moved up, instead of just selling the call, I may sell a call near term and also buy a near term higher strike call, do a bear call credit spread. And what does that do? Well, that allows us to take in income, but it leaves the upside open if the stock continues to run. So you may be losing on that $5 spread in the bear call credit spread, you took some premium up front, but in order for that to happen, the stock had to move up another 5 points, and your long call is still gaining. Your original long call is still gaining. And same with the puts. We might sell a near-term out-of-the-money short put option, create a calendar put spread, and of course we could do a bull put spread on top of that to create the credit spread to leave the downside open if the stock continues to run. We are going to look at examples of all these, but the first part of this presentation is just outlining some of the ideas, and then we're going to put those ideas in action using the power options tools. All right, so, sorry folks, management techniques in the case of a loss. We've hit our trigger point, that 33% loss or that 25% loss. Well, remember, if we had a trading plan, you want to stick to your trading plan. You don't want to outthink yourself. So if it's hit your target loss, you may just want to liquidate, take that loss, and then try to make it back with other positions as well. We never want to do that, but remember that is an option. What is the benefit of liquidating and taking the 25% loss now or the 33% loss without trying to manage it? Well, you stuck to your trading plan. You've taken out any further exposure or any further potential of loss on your long put or your long call as well. And you can make it back with other positions if you manage it effectively. What are some of the other ways? Well, if the stock has fallen, we've hit our 25 or 33% loss, and we think it's going to continue to move against us, well, we could sell half now. We're going to have a loss, but we still have some available, and we could buy the opposite security. You could sell all, of course, and buy the opposite security. That becomes a little dangerous because if there's a whipsaw effect, you could lose on both positions. So what you're trying to do here is help yourself pay for some of the new securities. So I have a put, and the stock has started to move up against me. For whatever reason, I'm just wrong on the position. I'm losing value on my long put. I may sell half of those. It's going to be a realized loss. I understand that, but I'm going to use that premium I got for selling half of those puts to maybe buy some out-of-the-money calls in the case the stock still continues to move up against me. Issue with that, of course, is the whipsaw effect. We know that. The stock could pull back now. Well, that's good. I'm gaining back on the 5 options I had remaining, or the half the puts I still had remaining, and now I'm losing on those calls, but I helped hedge the cost of those calls by selling half of the original security. Okay. Another idea is rolling the strike. Okay, so our stock, we bought a put, and the stock moved up. We're losing 25% on our long puts, or maybe 30% on our long put position. We could sell half now, and then roll the strike, roll our current strike. So sell half to take some of the premium, sell the rest, and maybe roll up with 50%, or sell all 10, and then maybe buy 5 at a higher strike. This may increase your cost basis into the position. That's why you're selling the original 10 to help hedge the cost of the new puts. And you're only doing this if you still think the stock's going to pull back. It's not a guarantee, but you're trying to get into a better position that might realize more gains if the stock does reverse and goes back in the direction you thought since it moved against you originally. So that's kind of the idea. You're trying to reduce your exposure. We could just say, okay, well, I was in this put, the stock moved up, I'm losing value on the put. Why don't I ladder right now and put more money into puts at a higher strike so if it pulls back, I can gain on both. I could maybe get back to break even on the first and have a small gain on the second. Well, that's a possibility. But the reason I don't like that is because we've already been wrong in the direction of the stock, and I don't necessarily just want to keep putting good money into a bad position. I want to help pay for some of that by selling what value I do have in my remaining options to move forward as well. And of course, we talked about doing the calendar spread aspect if we have a long call that's moved up and we think it's peaked out at the top. But we could also do a reverse calendar. I mean, let's say I bought that 150 call we were talking about when the stock was at 160, but the stock dropped down to about 149 or 148, maybe even a little bit lower, probably down to like 145 or so. So what I may look to do is instead of selling a 160 call, which has no premium now, I may consider selling a near-term 150, creating a calendar spread, or maybe the 147.5 or the 145. Does this help the value of my long call that's losing money? No, not directly. If the stock falls, you're still going to continue to lose money on the long option. What it does do, though, is it hedges it a little bit and it gives you some premium inside. Of course, what we're going to talk about when we look at the graph there is we want to make sure we're not trading against ourselves in that scenario where we create the calendar spread and we actually put ourselves into a different position. Another idea that's beneficial in the case of a loss, or can be beneficial, is a ratio repair. It essentially creates a butterfly on your long call position. Many of you may have seen the stock repair tool in Power Options or heard of the stock repair strategy where I bought a stock, let's say at 50, it dropped down to $47 and I need to repair it. Well, I may be able to do a ratio repair by buying a 45 call and selling 250 calls for 100 shares on the stock, or maybe, for example, buying a 47.5 and selling 250 calls, something along those lines. You can do the ratio repair in that aspect with a long call as well. It's going to create a butterfly, but it may help you get back to break even faster. But of course, most of the repairs here that we're talking about, we're selling half and then rolling the strike, or selling a near-term calendar spread against it, maybe even averaging down, rolling down the strike of the option, or the ratio repair. As with most repair strategies in any strategy, it only works if, of course, the stock goes back in your desired direction. Okay, so we'll talk about that too when we get a look at the profit and loss charts as well. Now, for a stagnating position, remember a quarter or a fifth of the time to our expiration. We've been in the position for maybe a fourth or a fifth of the time to expiration. For me, usually a 20-day mark is a good time period to get a gauge for the stock. But it hasn't moved. It hasn't done anything. Or maybe it's moved a little bit, but we're right back to square one, and we have a loss because we've lost 20 days worth of time premium. Now, in the case of stagnation, if a major event is upcoming within the next week or two, an earnings event, outcome of a pending patent lawsuit, or any kind of ruling in that case, or waiting for a lease to be verified or approved, let's say if you're doing an oil company or a mining company, a lease on land or something along those lines. Well, if a major event is upcoming in the shorter term, maybe under 14 or 15 days, you may want to do nothing. Just leave it open. You were hoping for maybe a little gain or a little drop in the stock or the underlying beforehand. It hasn't happened, but if we've got that event coming up, that's probably why we got in it. We may just have to bite the bullet and stay in it. Why wouldn't I sell necessarily a calendar spread in that scenario where it's stagnated and I've got an event coming up? Because we know that something's going to move. It's likely going to move based on that event, and the calendar spread's going to top you out on a profit line that might not match your goals for the position. We could, of course, reduce the cost basis right now. We could sell half and just take half the money on the table. It hasn't worked the way we wanted to. We still have an event upcoming, or maybe we don't, but I want to limit my exposure. Maybe my loss on the option is only 5% or 10%. Maybe I take half of that on the table so I'm not fully exposed in the position for the 100% loss if it goes the opposite way in the next following 20 to 30 days or so. You could, of course, just buy the opposite. It's been stagnating, maybe sell half, and then, of course, buy an out-of-the-money put, for example. Or if I'm in a long call, or if I'm in a long put, buy an out-of-the-money call just to maybe if it starts moving one direction or the other now because we're uncertain of what happened. And, of course, we could sell the near-term option against it to reduce cost, but we would only do that if we think the stock's going to continue to stagnate. And most of you are probably shaking your heads and saying, well, if I was in the position for 20 days and it hasn't moved, I'm likely just going to liquidate the position and take the 5%, 10% loss on it and look for something else that's more active. And there's absolutely nothing wrong with that either. Okay, it's got to be based on your risk tolerance and your expectation of the stock going forward. So all of those are possible ideas on how you might manage these different scenarios. But of course, how do we choose each one? Well, that again, it's going to depend on your conditions for the position, your risk tolerance, okay, your outlook for the stock going forward. Before you do a management technique, you're almost essentially reevaluating the entire position. Okay, so if I'm in a position where I have a gain and I'm looking to evaluate an adjustment, I have to look at the stock now as almost a new position and what are my expectations going forward. Any adjustment I want to do in a long call or long put should reduce the risk, reduce the exposure, and try to lock in profit on the position. Okay, lock in some of the gains if you have it, or minimize the loss if you're suffering a small loss. But you have to make sure that the adjustment you make matches your outlook going forward, and of course, falls in your trading plan and matches your risk tolerance. Like I said, it's not necessarily a great idea to continue to add calls or add options if you're in a stagnating position with the speculation it has to jump one direction or the other soon, because you're just putting more money into a position that's not going in your desired direction. Okay, and that's a concern. Your time remaining to expiration is also a consideration. If I held the position too long, nothing really happened, or maybe I did some adjustments, but I haven't met my goals yet, and I'm within 20 to 30 days to the expiration of the long call, that's going to help determine what management I do. Does it make sense to sell a call against a long call fund of 20 days to expiration? I'm essentially just creating a credit spread or a bull call debit spread to help hedge some of the loss. Maybe, but you've got to make sure that it matches your risk tolerance in that case. And of course, we also have to talk about the availability of funds when you're managing. That's one of the main reasons why I like selling half of the position before doing an adjustment, so I have more funds available to help with the adjustment techniques. And it also depends on your level of trading approval. In, of course, my IRA accounts or my restricted accounts, I'm not able to use the ratio repair or turn the long call or long put into a butterfly position to try to help manage it. I can in my cash account, but I can't do that, of course, in my restricted accounts. There's certain spreads I'm not allowed to do, and the ratio spread by itself is one of them. So it's all going to depend, too, on your level of trading approval. Because a lot of people will get level 1 or level 2 trading where you're allowed to buy stocks, sell covered calls, maybe buy puts, buy calls, but you don't get the ability to do naked puts or credit spreads until maybe level 3 or level 4 approval, depending on which broker you're using. And of course, the ratio spreads are closer to that higher end level 4 as well, because one of the options technically ends up naked. It's not in our structure, but it would look naked if you just entered the ratio call spread from scratch. Excuse me, folks, but most brokers have the ability to allow you to do that. All right, so now we're going to use power options to showcase some of these different ideas on management techniques. We're going to look at scenarios of a gain, too high of a gain, and then what we'd call a reasonable gain. We're going to look at scenarios of a loss, and of course we're going to look at scenarios of stagnation, and we're going to discuss the pros and cons of each kind of management technique we discussed here once we take a look at the profit and loss chart as well. All right, so all that being said here, let me navigate over to power options. Well, and let me just go back here a little bit. Oh, sorry, folks. That's I apologize there. Okay, 1 second here. All right. Did not do what I wanted it to. There we go. We should be looking at the power options screen. Fantastic. And what we're going to do now is we're just going to go into the My Portfolio tab on Power Options, and we're going to go into the Portfolio view as well. Just making sure. There we go. Okay. All right. So here are the portfolio tools. We've entered in some long options, of course, on positions that have moved up in price. Now, the first one we're going to look at is we're going to take a look at the gain here, and let's go just to the profit and loss chart on the position. And this is for RCPT. Now, currently, on June 1st, when the stock was trading about 162, we could have bought 10 contracts of the 160 call at 25.10. Okay, so our investment would have been 25,000. Probably wouldn't have done that. We probably would have maybe only bought 5 contracts, reduced this down to about 12,000. In general, by the way, whenever I buy a long call, I probably only allocate about $2,500 or so. So I may have just bought 1 contract here. In fact, let's go ahead and put this down to 4 contracts to make it more realistic with numbers. So we would have invested about $10,000 into the long call because of the high price of the stock. All right. Now, as we can see here, the long call gain that we have, it's moved up to $43.60 gain. The current price is $68.70. So we've got almost a 200% gain. So naturally what I'd probably do here in this position, the cost basis is about, we paid $25.10 for it, and the cost basis is now about $68. Okay. So naturally I'd probably just take this off the table. This is a good expensive stock. Has moved up 60 points from 160 to 229. Our option would have hit that delta trigger. It would have hit the probability trigger as well, and we've been hitting new highs on RCPT. It's been moving up consistently. So we would probably just take this off the table to realize the full profit. But if we thought RCPT was still going to move up in price, okay, what are some of the things we could do? Well, again, we're just going to use the 4 contracts now. So we're going to go back in. I'm going to tell the system we're going to sell 2 of our 4 contracts, and we're going to put in a basis, let's say around $70, right around the midpoint. Okay, so we're going to sell 2. Now the system, of course, isn't reading this as closing half the position. It's looking at a position that we'd have 4 open and 2 sold with the same expiration and the same strike. But remember, our original investment was $10,040. So we sell half of it now. What do we have remaining? We have a no-risk position. It's hard to see because the profit's all the way down here, okay? But we have no risk in the position right now. The max risk is minus $39.60 because just by selling 2 of those contracts at $70, we take in $14,000. And of course, we put in $10,000. If we only did 2 contracts, of course, you would have only had $5,000 invested, and you'd be able to take an easy roughly $7,000 off the position right now, so you'd have a $2,500 gain for just 2 contracts. So we've negated our cost basis in the position, and we still have 2 long calls available at the 160 strike that continue to move up if the stock continues to go up in our desired direction. So selling half the position in the case of this large gain, and of course, if we were looking at a lower price stock, let's say a $10 stock, and you only paid 25 to 30 cents instead of $25 for the call, and it moved up to 70 cents, you could sell half of it and you'd have a locked-in gain of about 40 cents per contract, and you still have the option half of your position available to continue to move up in price. Okay? Now, following that, what are some of the other things that we did? Well, let's take a look real quick at what's going on here with RCPT. So I'm just going to go to charts, and we're going to go to big charts. And I'm just going to look, let me clear up the drawings, folks, I apologize. I'm going to look at a shorter trend here. I'm going to look at about 3 months. And yeah, I'm going to leave all of that in there as well. Let's go to 3 months. Now remember what I said about gaps in price. So our position, you know, we cherry picked for examples, but in our position, we got into the position right around this time frame when the stock was at around 162, 163, and we bought that 160 call for the September expiration. And the stock had a gap here, but then it pulled back a little bit, pulled back again, started to move back up, and then it really gapped up. So this is probably an event, and look, there's that increase in increased volume we want, and the MACD crossover did exactly what we wanted. Would we have managed this position over here? Probably not, because it went up as we wanted to go within the first 20 days. It stayed up. It pulled back a little bit here. So we may have managed at this point as well, but staying in it, we allowed it to go up. So it gapped up in price, probably due to earnings. We've got an increase in volume, but we have that large gap. So now, looking at this chart, we have the gain that we want. As we mentioned, we could liquidate right now, take all that money off the table and be done with the position. We could close half of it and have locked in almost a $4,000 gain for that position. And if the stock continues to move up, we could still realize further upside profit potential as well. But if because of this gap, we think, hey, that's great, we had the gap maybe due to earnings, so the stock's looking good, but we think it's going to pull back and maybe come down to this price. Well, again, what we could do now, let's go back to our profit and loss chart there. All right, there we go. So we could do now, remember one of our other ideas is we sold half to lock in the gain. So let's say we have roughly $4,000 in unrealized profit on the position. These are expensive options, but maybe I want to take half of that and buy the opposite transaction. Okay, so let's take a look at the options. We may keep it out in September. So, wow, these are really expensive. Not really, though. So I'm going to take that $4,000. Remember, we have, in our example, we originally bought 4 and we sold 2, so I have 2 calls invested now. But I may go ahead and just say, well, why don't I buy 2 contracts of, let's say, the 200 put for September. All right, so we're going to buy 2. And, of course, with an investment of, bid-ask spread here, it's a 170 to 295. Let's go midpoint there, and let's say that we're going to get this at about 240. Okay, so we're buying 2 at 240. I'm using the almost $4,000 I had to help fund this. So in that case now, we've still got a debit on the position. But now if the stock continues to move up, we're still going to realize a profit on the call. And if the stock pulls back, we're going to have that put option to help hedge that value. Now here's that range. Remember, we're in a locked-in profit in this case of a high value, about $11,000 or so if the stock stays between the strike based on what we have invested and the value of that 160 call if the stock's between 160 and 200, of course, and the 200 put. So that's sort of where we don't want the stock to go. But if we think it's going to pull back slightly, this might be an idea. You could also ratio this so you still have a locked-in gain. Okay, you could add more puts depending on your outlook going forward, or you could just do 1 put, for example, and give you a slight skew, but you're keeping more of that original 3,900 there. You still have a locked-in profit, even if the stock drops down to 160, then you're moving up in price. I know these numbers are high, but this is the chart you might want to look for based on that expectation of the stock. We had that large gap, and we may think, hey, that's great, the earnings were positive, but if I think now it's going to pull back and hesitate, maybe I want to add a cheap out-of-the-money put to try to help me get some of the gain back, or I could just close all the calls again as well. Now let's go back to our standard 4 position at 25.10 for this expensive option. This is the case of a gain on a long call. Now, we could sell half to try to lock in that gain. And in this point, when I have this high of a gain, any gain above 90% or 100%, if I'm lucky enough to have that, that's where I usually sell half just to remove all the risk. But what we may do now is consider selling a call against it. same scenario. We think now the stock's going to stagnate or pull back a little bit. Instead of putting money in to buy the put that would gain the opposite transaction, maybe now what I want to do is go ahead and sell a short term. I wouldn't do July, of course, because we're at July expiration, but let me sell maybe in August. And with the stock trading right now at about 229 after that gap, maybe let's look at the 230, maybe even the 240 for 95 cents or a dollar, but let's go ahead and do the 230, 260 to 290 bid-ask spread, so let's call it 275, and we're going to sell 4 at 275. In this case, it doesn't give us a good value. And what I mean by that is that we reduced our cost basis by 1,100, but we still have the potential risk here of 89.40 if the stock pulls back. So we hedged it by about $1,100 or $1.10 or so for those 4 contracts, 275 premium. But now I'd consider if the stock drops back to 225, I may consider buying back this 230 call and maybe rolling it down or then getting out of the position. What is the benefit of doing this calendar spread in the case you have a gain? So if I was in a calendar put, we'll look at that. If I was in a long put that had a gain, we'll look at that in a moment as well. It's the same ideas. We would just reverse the concept slightly. Okay. So in this case, of course, what we look at is we could sell the call here, but remember we've capped our gain at this point because we think the stock's going to stagnate to August, the next 30 to 45 days, but it does cap further gain. Still very profitable position in that case because we had such a large gain, but we don't address the downside. We could still lose. And that's why, again, in this case, I'd probably go ahead and sell half, as we did before, for that $70 price. And remember now, what's going to happen is that if I sell the August calls against it to create the calendar spread at the 230 strike, I'm only going to be selling 2 because I only have 2 long calls remaining. Okay, no, sorry, 275. So now this is going to give us an interesting looking calendar spread where we have no risks to the downside. We've paid for that, remember. We still have a profit of $45.10. That's from the $3,900 locked-in profit we took for selling half in this case with a large gain, and the new premium of $275 we just took in for 2 contracts, that additional $550. So we've capped our gain up at the top. If the stock continues to move up, but we're quite happy with that. It's 410% increase. And of course, if the stock falls back, we still have guaranteed profits all the way down the line, but we would look to manage the calendar spread. And we'll talk about calendar spread management in a different webinar as well. So that's essentially the gain. Some of the ideas what you'd look for the gain. Now I've mentioned too, what is another idea? The other idea is not just selling the call, but doing a credit spread. Okay, well, we'd do a bear call credit spread on top of a long stock or on top of a married put or on top of a long call. And why would I do that? Well, the reason is I can still generate premium. We've bulletproofed the position, lack of a better term. We've got no risk remaining because we sold half with a large gain. We're going to sell half here. And now go back into August, same expiration of what I sold for the calendar. And let's go ahead and buy 2 far out 250 calls, 40 to 45 cents. So we'll just call it 45 cents. We're not going to get much of a midpoint there. All right. So now what have we got? Well, we get this little bump in the middle. It's still a reasonable profit, but we still have unlimited upside going forward because the stock continues to move up. Once we cross the upper strike price of this bear call spread, our 250 call that we bought for 45 cents, we've taken the max loss on the bear call spread part, but we still have the long call that's gaining in value. So we've got a nice almost synthetic long stock position. By doing this, we can still realize further upside, but we still locked in a profit, not as high as of just selling the calendar spread, remember, but we still have further upside instead of a cap gain if the stock continues to move up to 260, 280, or 290 along those lines. Okay, so that's something to consider as well. Instead of just selling the call to create the calendar spread to generate income, if you still have upside prospects, maybe look at a calendar spread view by buying a further out of the money call as well. You shouldn't have to cover margin on this because essentially it is a bear call spread. We sold at 230 and bought at 250, but your broker would probably read this as a calendar spread where you have a 160 and you sold the 230 against that, so you've already paid the debit, so you don't have to cover any margin requirement, and you're just adding a cheap long call that you've helped pay for with a short call sale. So it still gives you unlimited upside. Now for the put, we'd look at the same thing. And I'm going to go ahead and stock down here, and we're going to look at the put. We're going to review this real quick, and then we're going to get into what you guys probably really want to get into is managing a down position. So CMI, not a large position. I mean, it is a large position here. We're going to look at 10 contracts back on June 1st again. We bought 10 contracts at the 135 strike for $1.65. The stock's now dropped to 127. We bought the puts when the stock was at around 140. Okay, so it's slightly in the money put. And our put now has seen a gain of 451%. Okay, so let's go to the profit and loss chart. And again, what are some of the things that we would do here? Well, I bought 10 contracts at a reasonable price of $165 instead of $25 on our CPT. Stock has dropped as we expected, and we have a gain on our option. So what are the first thing we might want to consider? Again, liquidate the position, take our gain. It's priced at $9 right now. There's probably some increase in volatility due to upcoming earnings for CMI as well. It's 127, so we do have $8 of intrinsic value. Now, I'm sorry, again, we want to go to September, and we'd sell half, 910 to 940. So let's say we can get 925. Okay, so again, selling half of this now puts us in a position where we have a guaranteed gain. The max profit, of course, is if the stock fell all the way down to zero. But we've locked in a position where we can't have any loss even if the stock recovers. And now that we've got that locked in profit, what could we do? Well, we could buy the opposite transaction. The stock has fallen. Again, we look at the chart for CMI, see what our expectations are going forward. One more time, I'm going to exchange this back to the 3-month chart as well. There we go. So around June 1st, when the stock was around 134, 135, we bought our 135 at the money put option, and it's kept staying below the 20-day moving average, and then it had a gap down today, of course, which helped us out here. What I looked for these examples, I looked for positions that were under the 20-day moving average, okay, for an extended period of time. But in any case, this position here has worked in our favor. Now, if we think it's going to continue to move down in price after the gap down today, and we think it's going to continue to drop, we could, of course, I'm sorry, folks, there we go. We could, of course, buy more out of the money puts to sort of double dip as we did with the out of the money calls. If I think the stock has fallen and now it's going to hesitate around this area, that would be the perfect time to sell 5. Again, remember, because we only have 5 contracts left. We have weeklies here, so I'd look maybe 14 days out. And I'd probably sell, but I'm going to sell 5 of the 125s at about 165, okay? Which is the original cost basis of our 5 remaining contracts, which we've already paid for. So now we've created a calendar spread that has no risk. If it continues down, we have that gain, but we've generated $1.65. And with the single strikes, we even could go up to 128 or 126. But remember, the obligation here is a little different. When I sell a put to create a calendar spread against a long put that's successful, remember this short put contract does obligate me to potentially buy shares of stock at that price. Now sure, I've got the long put here at 135 that I can use to sell. I can force someone to buy it so we can close out of the position, almost like a bear put debit spread, for example, that goes in our favor. But in this case, just remember that this does give you an obligation. If the stock does drop to 125 or 126 before that expiration, you may be assigned early. You may have to buy shares of stock, but then hopefully your broker would go ahead and activate this automatically. They do that for a debit spread. They might not do that for a calendar spread. So you got to be careful with that as well. Okay, so that's doing that. And again, we talked about how would I do a credit spread now? Well, we did a bear call to leave our upside open on the long put. So we do a sort of bull put here where we sold the 125 for July 31st. So now I might want to buy it cheap, maybe even a 120 at about 75 cents. So buy 5. And so if I still think the stock's going to continue to move down, sold half to lock in the profit, generated some premium by selling the 125 puts, and now by buying that further out of the money put at a cheap cost, paying $375, so we're still taking almost $500 in that credit in. We still have a synthetic short stock position, roughly. So the stock can continue to drop. We can still realize the upside potential. Okay, but where there's a gain, my friends, there is a loss. So let's go back to the portfolio here. And here on CMI, we write it about our target price. So at the same time, June 1st on CMI, if the stock, we entered a call instead because we were bullish on the position. So we bought the 135 call for $1.85 on June 1st, and it's now trading at 115. So we've lost 37, almost 40%. We're probably close to that trigger that we would have set for the 33% loss. So what do we do to manage a reasonable loss on the position? Again, let's go to the profit and loss chart, and let's review what we discussed earlier for the management techniques. We didn't have a lot invested, 1850. It's a good manageable number for 10 contracts at the 185 price. Okay. Now the stock's fallen against us. We know liquidation would be about 115 or so. So we're at that 37% loss range right now. What is the first thing we could do? Okay, well the first thing, obviously, we could liquidate. Okay, so we could just close this position, realize the 37% or so loss, and then look to make it up with a long call or a long put on a better stock that moves in our desired direction. Now, CMI again, before we go any further, I want to take a look at that profit and loss chart for CMI, Cummins engine. So we see here we bought a call at around June 1st, looked like it was going good, and then it dropped, and then it had that big, we thought it was coming back up, 132 or so, and now it's had that big drop again as well. Okay, so now, what are our expectations going forward? Well, sorry folks. If we think that the stock's going to recover and move back up in price, we could limit our exposure by selling half. Okay, so with the stock now at 127, we could go ahead and sell half of our positions at 115 on the loss. So we're trying to reduce, remember, exposure. One of the two things we want to do, if we have a gain or we're looking at a loss on our position, we might be able to get 120 for this. So we're going to sell 5 at 120. Does this prevent me from losing more on the position if CMI continues down? No, it doesn't. What it did do, though, is it reduced my exposure slightly. So it's a decent percent. We reduced it by about 600, which is about a 30% reduction. We could also do more in the ratio aspect. Okay, I could sell half. We sold half. I could sell 3/4. We could sell 7 contracts and try to reduce some of our exposure if it continues down. But now that you sold half, what are some of the other ways we could look at here to mitigate this? Well, now that the stock has fallen, if we think it's going to continue down in price, we could leave the half open, and we could take, remember we sold now for 120, so a little bit less. I could buy 5 110 puts at about half the price. That's what I would look to do. Yes, it's deep out of the money. Yes, I'm probably not going to see a gain, but I've just taken $1.20 for 5 contracts, so I want to look for half of that. Okay, maybe 60 cents or so. It looks like the 110 is there for me. So I'm going to buy 5 of those. And we'll say 60. Well, not 6 cents. I apologize, folks. There we go. 60 cents as well. So now what's my exposure? Is it 115? But if the stock continues to move down, well, that out of the money put's really not giving us anything more. So we could go to at the money unless we really expected the stock to fall in price. But we could go more at the money. But again, probably don't want to go too far above that 120 cost because we're taking away everything we just kind of gained back. We didn't gain much back. We're just reducing exposure. And this still keeps us at a lower exposure, but we have created that long strangle now where we're maybe expecting a sudden move one direction or the other. Okay? Depending on the profit and loss chart, I'll be honest with you. We talked about does it match your trading plan and does it match your goals? This doesn't match my goals. I've reduced the exposure again if the stock stays within this trading range, but I've done nothing to really benefit if it continues to drop. So I wouldn't do this adjustment because of the cost basis and only what I can get for selling half right now as well. We could liquidate all of our position and then buy puts, sort of reverse the entire idea at this point. We're going to take that realized loss of 37% of our calls, and then we'd have to factor that into the cost of the new puts if we expect the stock to go down or try to get advantage of it. A lot of investors that I talk to who trade long options, they'll start out with a long call or a long put, but over time what they end up doing is simply just really they're straddle and strangle investors. When they get a gain in the call, they'll close it and then buy puts looking for a retracement. As the stock pulls back, then they'll sell their puts and maybe buy calls again, now looking for a movement in the other direction. So they're going in and out of straddles and strangles. But a lot of investors, retail investors, are more maybe along the lines of you and me perhaps. And there's nothing wrong with doing that. Legging into straddles and strangles I just talked about can be very lucrative, but it takes a lot of action, a lot of activity. But in this case, maybe we just decided it's time to take our 37% loss, that trigger that we hit, and liquidate and move on. But we sold half here. We reduced our cost basis. Doesn't look like the out-of-the-money puts are going to cut it for me. What about here with the long call, converting it into a calendar spread? And before we looked at the gain, and we were going to sell a near-term call that was above our long call strike price. Here we can't do that. So if I go out to July 31st to try to take advantage of the weekly shorter time decay of selling an option, or even out to August, standard expiration the 21st, but let's keep it here at the 14-day out, I can't sell the 135 call, the 136, the 137 because, well, there's only 30 cents, 20 cents of premium. I want to hedge this bet a little bit more. So with the stock now trading at 127, we own the 135 September call. Maybe I want to try to sell the 130. It's at 165 and 190. Remember, we closed half, so we only have an exposure of 1550. Let's go ahead and sell 5. I apologize, folks, of the 130 call for, again, about 175. Now, what have we done? We've greatly limited our exposure if the stock continues to move down. We can still have a loss here. In fact, I could sell lower strike. I'm looking at the 130. We could probably sell the 129 or the 128 and almost get this to no risk as well. Where's the con? The con is the rebound. Okay, so the stock has fallen. We've taken some money off the table by selling half of the position that's losing against us. We're getting some money in by selling 5 contracts of this new call to create the calendar spread. So if the stock continues down, we've reduced our exposure from what was originally $1,850 for those calls down to only $375. But if the stock pulls back and it moves back up to 135, now we're at a loss of $1,100. Still below our original $1,850 in, but because we had to sell this call below our long call, we've done a reversed calendar call spread in this case, and now we've got some exposure to the upside if the stock recovers. Okay, so that's one of the things, again, we had to talk about. Whenever I'm looking to do an adjustment, you have to reevaluate the position. When you're reevaluating the stock chart now, you're saying, well, what are my expectations going forward? If I think CMI has fallen, and I think the stock is going to move back up in price now that it's hit the bottom and that it's going to pull back up, well, that's where I might sell half and roll down the strike as we talked about. Okay, so I might have sold half here to reduce the exposure and then taken this 120 and maybe bought some 125 calls, sort of double dipping. So now if the stock recovers and moves back up, I can gain on the new 125 calls, and I helped hedge that by selling half of the position, and I could still gain back to close to where I was, maybe on these 135 calls. That would be my expectation. If we think the stock's going to continue down, well, that's where we would have sold half perhaps to help hedge and remove our exposure, and then maybe bought a put. I didn't like the put. It didn't make sense to me because it was too wide. I'd have to select a different put. Or maybe we just liquidate the position and buy the whole opposite transaction at that time. Or if we think it's going to stagnate here and it's going to remain for the next 14 to 20 days or so between, let's say, 125 and 130, that's when the calendar spread, or selling that near-term call against it once you've sold half to generate some premium in, this is my target of where I'd want to be. So based on your expectation is going to dictate what you want to do. But as you can tell, I'm a fond proponent of not leaving the entire position open as it was. So example, we started off with 10 contracts. Even if I start out with 5 contracts, if I have a gain or if I have a loss, my first thought is to sell part of it to hedge my exposure. In the sense of a gain, we can cancel all the risk, as we saw before, so we have no potential for loss, and then we can try to look for ways to lock in some of that profit by buying the opposite strategy, buying a put against a call that has a gain, or buying a call against a put that has a gain once we've sold half, or creating the calendar spread to generate some more premium against it. This is also a good approach to use in the stagnation, if and only if you think the stock's going to continue to stagnate going forward. But it all depends on your new expectation going forward. That is paramount as well. Now, I'd mentioned before, one of the other things that we talked about is the ratio call spread. So here we have the September 135 call we bought on CMI, and we have a loss in the position. And if I factor in the cost basis for my calls at 185, well, that would be a cost basis on my stock, if I had owned stock outright, of 136.85. Meaning that if I exercise my call now, I wouldn't because it's a loss, but if I did exercise my call and bought 1,000 shares of stock at 135, my total cost basis would be 136.85. So, in that light, what is something else I can do? Well, as I mentioned, one of our signature tools is the stock repair. And this is a ratio spread that might help you get back to break even. So I could do CMI, and I'm going to put in cost per share of 136.85. And I'm going to put in 1,000 shares. Okay, so we know the stock's trading $9 below that. It's roughly at 127. So let's go ahead and submit this. And we have a problem. Okay, so there are ratio repairs that have been built. But notice that the only ones that have been built, the ratio repairs that are available, are the ones out to December 2015. Why is that a problem for my current position? Well, if I did own 1,000 shares of stock, and my cost basis was 136.85, and I performed this ratio by selling 2 130 December calls and buying 2 125 December calls. Let's take a look at the repair details here. We generate a small credit of 220. Okay, but now instead of needing the stock to go back to 136.85, my new break even on the stock would be 129.83. So if the stock hits 129.83 at or around December expiration, I'd be back to break even though my original cost basis was still 136.85. That's the advantage of the ratio repair. But using the stock repair, and if I only find one that has a December series, let's take a look at the profit and loss chart here and see how that works. Sorry, it opened up in a new window. Let's open it up. So here would be my ratio repair, and it's not a great profit potential, but notice it's because my break even now is at 129.85. So we could get back to break even without needing the stock to go all the way back up to 136.85. Okay, that's the advantage. But remember, here's the trick. I don't have shares of stock, do I? I've got a September long call. And remember, some of you might be saying, oh, well, you sold 20 calls and bought 10 because we had 1,000 shares. It's a ratio call spread. So 10 of those contracts are naked. Well, no, because I own the stock. So it's like doing a covered call where I owned 1,000 shares of stock and sold 10 contracts at December 130 and have a bulk call debit spread. But in this case, unfortunately, we don't have that. We have a September 135 call that we paid 185 for. So why is that an issue? Well, it's because this long call is going to expire before the benefit of the ratio repair. So in that case, at September expiration, if I don't liquidate the whole position, I will be in a position where I have 10 contracts that are naked. And that's a problem. And this is a problem too. We don't really get the repair that we want. Okay, this isn't helping repair our position. If the stock moves, we could still have a profit. But if the stock stays where it is, we have more of a loss now on the position. And this is looking at our near-term expiration, okay, the December expiration. But what is this? This is essentially a butterfly. You're long 135 calls, you're long a 125, and you've sold 2 130s. Could I do a different sort of butterfly repair looking at the current strikes? So let's go to September itself, the expiration of our long option. We own the 135. So I may want to buy a 125 call, 540 to 570. So let's call that 555, I guess. And sell twice as many 130s in the middle. And we'll call that at 290. So I'm going to sell 20 calls at 290 to compete the butterfly. And we said we're going to buy 10 of these. I said 555, is that correct? Okay, let's go ahead and submit that. Now, this is a reasonable butterfly repair. You know, we tried to do it with the stock repair tool and I didn't really like it, but this is more of a reasonable butterfly repair, especially if we think between now and September, and it's hard to gauge because we're 63 days away. But if our target price is now that we have an expectation the stock's going to stay, oh, I'm sorry, that's too much of a circle. Much better. The stock's going to stay within this range between these two break-evens, which is now 133.40 to 126.60. We think there's going to be a stagnating period. This would be a decent butterfly repair. How do you create the butterfly? You had a long call here that's now out of the money. So you essentially want to sell twice as many close to at the money calls. And of course, the stock at 127, really 128, the 130 is closer. And then we want to buy 10 calls that are the same distance. I don't want to do a broken wing in this case. You could, but I like to keep my butterflies even if I use this as a repair. So we had the 135 that's moving against us. We want to sell maybe the next strike down twice as many. So 2 times next strike down at 130. That's our sell. And then you buy the same amount of the original at the next strike below. And that's a true butterfly. Broken wing butterflies are popular. What does that mean? It means instead of buying the 125 call at 555, I may buy a higher strike call, maybe even a 140, but only buy half. Okay, so I might buy 5 140s. I might even buy 5 125s. Would be a broken wing butterfly. Let's take a look at that. Let me erase the drawings, folks. I apologize. So let's just buy 5 of these. So what does that mean? We're going to get more advantage of this credit that we're selling 20, but now we've got a problem, don't we? Who can see the problem? Problem is now we've got infinite risk to the upside. We get a better profit peak here. We have no risk to the downside if the stock continues. We have infinite risk to the upside. Why? Because we're missing protection. We've got 20 short calls, 10 long, and 5 long. So we're short 5 calls. There's 5 calls that aren't protected by anything, and that's the infinite upside. That's why I don't like doing these sort of ratio ones, these ratio repairs with a long call, or trying to repair a ratio long call with a butterfly that's ratioed for that example, because I don't want to leave anything naked. Because remember, that was my direction I thought the stock was going to go. So in this case, if I think that it's going to stagnate going forward from now, this might be a reasonable butterfly repair. And you could even convert that a little bit more. You could do some other obscure things where you sold 10 of the 130s and maybe sold 10 of the 125s and bought a 120. So you have more of an iron condor or an all-call condor with a wider range to break even, but less of a profit range at the peak. Instead, we'd have a trough here with sort of the call condor that would look like this. So we wouldn't have as much profit in between the strikes, but we'd increase the upper and lower break even. And again, that would be created by maybe selling the 10 130s, selling 10 125s, and buying 10 of the 120. Let's just graph that real quick. Is that a reasonable repair for the position if we're expecting everything to stagnate? I'm not sure. So let's just sell 10 of these. We're going to convert this, and we're going to sell 10 of these as well. But now at the same time, I'm going to buy 10 of our 120s. Okay, but it's going to be expensive, right? Because we're doing an all call, and these 120s are more expensive because they're deeper in the money. $8.30 to $10.80, so it's about $1, so it would be at $9.40 or so. Probably higher, $9.50, but let's just use that as an example. So here's our all call condor. Our break evens are wider now to $122.80 and $132.20. But it's done at a debit. So now we've got that $2,800 exposure, which will happen, of course, if the stock drops below 120 at September, or if it goes above 135, our 2 long option strike prices. And then, of course, we could do the same thing we talked about with the put. All right, so back to square one. If we were long a put that's declined, what are some of the things we could do? Liquidate, take the small loss. Sell half, and if our expectation now for the long put that it's moved up in price, if we think it's going to continue up, we might buy half calls. So we sell 5 of our contracts to reduce the cost basis, buy 5 calls in case the stock continues to go up. Remember what we wanted to do there, get 50% of that price. So if I sold my long put that was declining, it's at a 37%, 33% loss now, I'm sorry, and I want to sell half of it and I get 120 for it. If I buy out of the money calls now, I don't want to pay more than 60 cents for it if I think the stock's going to continue to move against me. Again, most of you are shaking your head and saying, well, at that point, if I think the stock's going to continue to move against me, I want to get out of the whole position. And there's nothing wrong with that. What you're kind of doing here is saying, well, what if A and what if B? What if it continues to go against me? Okay, I'm going to try to take advantage of it. What if it comes back the other way and it goes in the direction I wanted? I want to make sure I'm taking advantage of the downside as well. In the long put, of course, you would just sell an at or out of the money put once you sold half to create that calendar spread. But remember, you're going to cap your gain. You're going to reduce your exposure to the upside now if it continues to move against you, but you still have a loss on the downside. And ratio repair, creating the butterfly, same kind of concept. What you would do is if I had a long put, let's say in this case, it may be we bought a put and the stock had moved up against us. And let's say we bought it at 120 and the stock had moved up to 127. Well, what am I going to do to create that butterfly? Well, I'm probably going to sell 2 125 puts and buy, we're going to sell twice as many 125 puts and then buy maybe the 130 puts. So we have a 120 put long that we originally got that's moving against us. I'm selling 2 at the next strike higher or just at the money, as close to at the money as I can at the current stock price. Then I'm going to buy another higher strike put that's in the money that will reduce the cost basis, but that'll help us create that butterfly or that condor to repair the long put that's moving against us as well. And then, of course, just last but not least, we talked about management on stagnation. I'm just going to pull up a quick view of a portfolio stock that's been stagnating here. And if anyone has any questions, I'm sure you probably have a few questions or you have some other ideas you might want to share, go ahead and send those in as well. And here we took an example of IBM. And let's just go to the profit and loss chart here. It doesn't matter if it's a long call or a long put, but it's been stagnating. Here it's a long call. And same scenario. We got into the position theoretically on June 1st. Okay, there we go, 3 months. And this was a long call position. So around June 1st, we got into the position when the stock was trading around 170. It pulled back. We might have managed it at this time when the stock was down at 165. But now after about 35 days, 40 days in the trade, we're sticking right at 170. Okay. So again, what are some of the things I can do now? We see that we paid $7.05 for that 170 October call on June 1st, and it's currently trading at $6. So we lost about 15%. Haven't hit our target, but we're losing time value on the position. So what are we going to do? Well, let's take a look here. I'm going to go to the stock research tool very quickly. 7/20/2015. Okay, so that's our next earnings for IBM. So in this case, I've got $7,000 invested. We've got a $1,000 loss or so because it's valued at about $6,000, but I've got earnings coming up in about 4 days. So that's the first step. You got, even if you had the long call to begin with or the long put, but in this case, when we're talking about stagnating positions, it's still trading right at around our price at 170. We've lost $1 in time value on our option. Earnings are coming up in 3 days. So what am I likely to do? I'm likely to do nothing at this point. Okay, maybe I'm still bullish on the earnings. True, IBM is never one of these ones that has a 40% gain in the stock or even a 25% gain for positive earnings. We may see a 5 or 6% gain, but that's significant for IBM. So with earnings coming up, I may do nothing. But with earnings coming up, when the stock's been stagnating, we're not sure the direction it's going to go now. What is our other concept? Remember, we can sell half, and at this point, I'd probably buy the opposite. Okay, because I have earnings coming up. I don't know what's going to happen. Let's go out to October. Let me sell half here. Let's call it, we're going to get a price of 610. So we'll sell 5 contracts at 610. This reduces our exposure on the position. We've got 5 contracts remaining with an investment of $4,000. Didn't cut it down by half, of course, because we've lost some of that time value, but that's okay. We've got $4,000 in the position, and we generated $3,050. So I could go out to October, but knowing that the earnings are coming up soon, I may just buy, let's say July 31st. What did I generate? I'm sorry, folks. What did I generate? 610. So we generated $3,000. Well, I'm not going to use all of that. I'm just going to buy 5 contracts here. Let's say of maybe the 160. Now, let's take a third of it. Let's buy 5 contracts of the 170 put at, let's call it 250. Okay. So we're going to buy 5 of the near term at 250. Now this is sort of a calendar straddle, lack of a better term, but it is a straddle. So with the stock at 171.83, we have an upper break even of 178.90 and a lower break even of 160.85, which, by the way, remember, when we bought into the position at 170.75, our upper break even for the original position was 177.05. We've only increased that by about $2 or so to a break even. That's not bad. But also remember that in this scenario, I do have the October calls, so I'm not going to lose a lot of time value on those, and the stock gaps up because of earnings. This one, I may lose all time value on. Right? We bought the out-of-the-money 170 put for 250, but it's the July 31st expiration. It's only 14 days. We're playing that earnings play by creating the straddle. Max loss here is 29.20. Well, it's better than the 7,000 that we had initially. We still cut it down by half, and now we've bought the puts here. So the most we could lose is 29.20. We have reduced our exposure. But if the stock pulls up or goes up to 178 or 179, we're going to get a lot more on that call than we're probably going to lose on the put. Right, so 171.93, we still have $6 in value for that October call. The stock gaps up to 178 or so, 179. We'll lose the 250 we put into those 170 puts we just purchased, but at the same time, our long call is probably going to be worth $9 or $10. We still have 5 months, I'm sorry, 4 months essentially of time value remaining, really like 3.5, but 3.5 months of time value remaining, and we're owning an option that's $9 in the money, so it won't be as high as $10. So that would now be a profitable position. What if the earnings are bad and this pulls down to 162 or maybe even 158? Well, that put's going to help us gain some back, but we're probably going to lose more on the call. All right, so that you would want to set this again. What is the key that I'm talking about here? The key is, what is your risk tolerance and what is your expectation? We have a stagnating position. We've got earnings coming up in 3 days. We want to maybe look for some kind of profit and loss chart and some adjustment with a straddle or strangle, maybe even use the October puts to try to get a better view there and have less time value decay in the short term. Because remember, these July 31st options are going to be very affected by the earnings. The implied volatility crush is going to occur. We're going to see other things as well happen in that time frame. Okay, so that's what you want to look for. Let's say earnings weren't coming up and we've got our stagnating position here on IBM. It's right back to where we started. We had that dollar loss. We sold half, but depending on your direction of the stock now, with it 171.93, I may look to go ahead and sell that shorter term again, maybe the 175 call at about 191 and 210. So let's call it, sorry folks, let's call it 195. We're going to create that calendar spread. We're going to help hedge some of the time value loss we've had on the position. But what are the cons of this one? This is not what I would do before an earnings. Okay, I would not do this play. But if earnings have already passed and we're going forward, we may be able to hedge our cost basis again. Remember, we reduced it by $3,000 down to $4,000 invested by selling half, trying to get back some of the time value. And now we sold 5 calls to create the calendar spread and reduced our max exposure down to 3,000. More than half. Remember, more than half of what we originally started on the position, and that's a reasonable move. We invested $7,050 originally. We've now reduced our exposure to 30.25. Do we have unlimited upside profit potential anymore? No. With just selling the call, selling the near-term option, or selling the put on a long put, we cap our gain to a reasonable profit if the stock ends up at 175. And we use the weekly, so it's in the next 14 days or so. But if the stock gaps up higher in the next 14 days, we may realize a loss to the upside. And what did we talk about before? How do we counter that? Well, we've reduced our cost basis by half. We generated some income by selling the near-term call. But if I wanted to leave the upside open, what do I have to do now? We've got to add that extra long call, and we keep it for the same expiration of our short call. Let me go up to, I'm going to go high. I'm going to go up to 185 with 14 to 22 cents. So let's call it 18 or 19 cents. We're going to buy 5 now at 19 cents. Now what is this? Just remember this portion right here, this 2-block trade right here, we sold 5 of the 175 calls at $1.95. We're buying 5 of the higher strike 185 with the same expiration July 31st for 19 cents, 20 cents or so. What does that give us? It gives us a bear call credit spread with a net credit of about 175 for a 10-point spread. Okay, but because we own the long call, we're going to get that sort of synthetic long stock position with a hiccup in the middle, right? And that hiccup in the middle is the range between the strike prices. But does it match our risk reward? No, it didn't. Sorry, I might have to go with the lower strike, the 180 here, because I don't want this to go back into a loss zone. I still have infinite upside, but I'm kind of losing out on what I want if the stock continues to move up. So here I might just stay with the standard calendar spread instead of doing this particular bull spread. And with the standard calendar spread, remember, I'm only doing this because there's no event coming up, and I think the stock is going to be between my upper and lower break-evens within the next 14 days. Okay, so I've hedged some of the costs there on the position as well. Okay, let's see here. Okay, did a good question going. Okay, so I'm sorry, I just had to read all of that first. This is from Clyde, and Clyde has a position for us. Clyde says, can we model this, please? I was tired of hearing me talk. I'm just kidding, Clyde. Let's go ahead. So Clyde says, we bought 10 August 85 calls on June 19th when AMBA was trading at this price. It's fallen to 108 today. The loss is approximately $30. Okay, so 10, let's look up AMBA first. Sorry, and sorry, Clyde here. Bought 10, August 85 and June 19. The stock was trading at 118. So you were $30 in the money. Stock's at 109.44. Sorry, you said the June? Sorry, August. Okay, so August now. So $30 in the money. So the 70 calls right now are going for about $37.80. And when you bought your 85 calls, you're about 30 points in the money. So I'm assuming your cost basis is going to be around $35 or so. Actually, probably higher than that. Yeah, you're probably at about close to $40 for the cost basis of those calls. So we have 80 calls. You can tell me your cost basis if you want to, Clyde, but I'm just guessing here. 85 calls, and I believe you probably paid 10 contracts, and you probably were in the $40 range, maybe even higher as well. I don't know what your cost basis was for those long calls. They're currently, what are the 85 August calls now? They're currently at $24 or so, so you're about a 50% loss in the position. 34.20. Okay, better. Something better to work with. 34.20. Thank you, Clyde. All right. So 34.20 now. Stock has dropped here. You're still deep in the money. So what again we talked about here for our ideas on managing for a loss. Number one, you could liquidate and take the small loss. What was our price here? We saw it as about $26. So for, why am I in August? I don't want to be in August. Yeah, I do. All right, so the 85s, we're looking at, let's call it $24 or so. Okay, so you've got an 8-point loss, close to $10,000 as you mentioned. Okay, yeah, that's right, 24, so it'd be about a 10-point loss. Let's call it 24. Current price is $24, okay? Now, one thing I want to look at quickly is I'm not going to give you any advice on what you could do. We're just going to walk through the math, but first I want to take the chart. Again, it's important to analyze that. We've had that drop recently, but it's pulled back up, and you've got sort of a MACD crossover almost going on, and the RSI increasing, but volume is decreasing as well. So you've got to move back above the 20-day moving average. So where's our guess here? Well, your guess is as good as mine, but what is our guess? So if we think the stock is going to continue to move down in price, what are some of the things we could do? Again, we could select to sell half. I'm sorry. Oh, I'm on the wrong call. That's okay. It's still the same. The price is going to look the same. So we're going to sell half at 24 even. Let's just put it there. Or even 24.20, for example. But what does that do to our exposure? Naturally, that puts our exposure down to 22,000 now. We've reduced half, but we're still in a losing position. We generated $12,000 by selling half. Now, what could we do? If we think the stock's going to continue to drop down, we could go ahead and buy same August expiration, maybe something along the lines, so I'm sorry, there we go. Okay, so probably something along the lines of maybe even the 100 put there. Oh, I'm sorry, that's not what I wanted to do. I want to go to this range. There. So I'm thinking maybe in the 95 range or so at 240 might be a good strike, but it's so far out of the money now that unless the stock continues to pull back, I don't think you'd see a gain. So maybe the 100 put we'll stick with right now. So we buy 5 at 350. Let's say 360, I'm sorry. There we go. All right, so here's one idea. We sold half to reduce our exposure, taking it down to $24,000, and we put some money back in for the puts, but not really doing what we want unless you think the stock's going to continue to drop below 100, loss of 16,000, half. You know, the max risk now is only 16,000, which is about half of your original exposure, okay? But again, does this match what you're looking for in your trading plan? Possibly not. So we sold half there on the position, but it doesn't look like buying the put is going to give us a range we want. Could we buy another put? Sure, you might be able to buy the 110 slightly in the money, and that would cost more, but it might give you a better profit and loss chart in the middle. Okay, so if I went straight to at the money now, which I typically don't like to do, if we went to the 110, now we're looking at about 790. My 5s of the 790s. Didn't reduce much, and you're not getting much benefit out of it. You know, the max risk is 1365. That's good. That's less than half of what your original exposure was, but where's your gain? You know, it's not doing what we want. You're not looking at much potential for a gain. Okay, so we talk about liquidating now. Don't want to do that. We're selling half to kind of cut our exposure down. again, but still leave the upside open at 22.20. Sell near-term option against the stock's at 109.44. You've got an 85 call. Let's look at a shorter term position, July 14th, and let's go ahead and look at probably the 115. Still got a reasonable price. I want to give some room here, but we're still going to look at like 220, 230. But again, it has to match your goals. So you could take the at-the-money option at the 110 with a stock at 109 or the 112. I'm just going to look at the 115. Oh, sorry, what was my premium again? Is it 220? Don't like it. Yeah, it's not going to do what I want it to do there. Did I reduce my cost basis? Yes. Do I leave myself potential for profit? No. Do I want to sell an in-the-money call that's below the price now? If I think it's going to continue to fall, that's risky because you could get assigned at any time. So let's say you got more premium by selling the 105 at about 680 or so. I don't think this is going to give us what we want either. Okay. Well, see, you could sell the 90, but the problem is now, because of the cost basis, remember you have a cost basis of 34.20. If you sell the 90 call or the 105, what we're doing is we lower the strike we're choosing. You've only got this 10-point difference now. Here's a 20-point difference, okay? But you paid 34.20, and this is why it's important to hedge in this case, because you dropped your cost basis down to 26, okay, in a true calendar spread. What did you do here? So let's say you paid 34.20. We sold half of it and lowered our cost basis down to about 24,000, okay? But now we're selling a 105 call, or even if you sell a 90 call, let's say you sold a 90 call, well, now you've only got a 5-point difference. So you're only going to get 2,500 back between the strike prices. It's going to look worse. What you're doing if you sell a lower strike, you keep selling the lower strike call, you're getting more premium to reduce your exposure, but you're increasing the loss you're going to have here. So the 90 would look more like this. Okay, I don't think that's going to match your goals because of that 5-point strike difference, because you're going to get assigned. Okay, that's what's going to happen. And that's where you run into the risk. Okay, could we go back to this 105 call and now say, okay, well, the stock's at 109. We've sold the in-the-money call, which I don't want to do. Let's go back to the 115. And these are stuff that you really want to do on your own, Clyde. You can start playing around with these numbers here on your own, looking at the different charts and everything. So we sell the out-of-the-money 115. And what if we went ahead and went with the 120? I'm not getting much here. It's about half. So again, we're going to sell 5 at 225. Then we're going to put that credit spread in. We're going to buy 5, and it was about 140. No, 120. Oops. Sorry, folks. Here we go. Okay. Still, I mean, it gives you that synthetic long, but your break-even's not up to 133.39. What am I doing here? Does this match your goals? Not only your goals, but does this match your expectation? Is this really helping your trade? Well, you've limited the exposure. You potentially have 5 shares of stock here that you might have to deliver on, and you bought 120s. It does give you a synthetic long, but you still have that high exposure there, and it's still not looking there. So what about the calendar? Not the calendar, I apologize, the butterfly. How would I do that? Now, this gives us a lot of opportunities because you're so deep in the money. But remember, in addition, that one we were looking at, the butterfly really works best in stagnation because you're selling right at the range, okay? What do I mean by that? Well, we had bought the 170 call, and the stock's at 171. It hasn't really moved. So I could sell the 175s and buy the 180, and that gave us a nice butterfly. Here with it at 109.44, if you think it's going to continue to stagnate, you know, you may have to go out to the same August expiration, doing at 85. So I may sell 10, because remember we sold half already to reduce the cost basis, so we have 5 calls remaining. So I may sell 10 of the 110s and buy 5 of the 120s. But this would be to the August expiration. I don't like it. It doesn't solve our problems. We're not getting into that profit zone. Is your loss only 4,700 in this scenario? Yeah. Okay, so that's something you could do. Okay, so you said the stock would be between 105 and 115. So you'd want to kind of look at which scenario would give you the best outcome for that range. And I don't know if I like the first two that we saw there. You may be able to get better profit by doing 3/4. Let's sell 7. So you only have 3 contracts remaining with a cost basis of 1740. And I could go to July, so, sorry, 105 to 115. So, yeah, maybe let's look at the 112 call here, sell 3 at 340 for the calendar. Not going to give us what we want here. Again, no, still not where I want to be. So it's not looking like you're going to have a good repair there. The ratio might work for you, again, or the butterfly, but you'd have to play with the numbers and see what's available, okay? As well, of course, yeah, Clyde had mentioned, what about rolling out? Sure, you could do that as well. You could try to roll it out further in time and at a different strike price. You know, that's an opportunity as well. So I'm sorry, let's go back here to August. Yeah, so these are all things you want to use the power options tools. That you can do this yourself, Clyde, in your spare time. You can kind of play around with some of these scenarios here. Like I said, we're not covering every potential for the different ways you could manage it, but rolling out is one if you think you've lost the time, okay? And we could sell this now, our 85 call for 24, sell all of it. And then let's say buy a September or maybe even buy in October, but try to get a lower price, and maybe the 105 or maybe even the 100 here, but let's use the 105 at 12.15. Reduce your exposure down to about 22. So what would your cost basis be? The cost basis will come out to about $23. After the closing, we'd see a cost basis here of $22.35. So now we've got a 105 call at $22.35 with September expiration. Would selling the 110 maybe against that for the short term get us profitable? Probably not, but now at least I could go to August instead. And let's look at maybe the 115 call, 420 to 440. Submit that. It's just not getting us a profit because we're just not getting enough premium because of that $10 realized loss that we had on the original position. But sell 20 of the Augusts at 430, and to make it work, yeah, 180, 190, I'm sorry, buy 10 at 190. I still don't think this is going to get us what we want. Well, now the loss is reduced to only 2,800 at the peak if the stock's at 115, but you generate here with the butterfly, you generate an $8,600 credit for the 20 that you sold and paid 19 back, so you're looking at a good, reasonable, almost $6,400, $6,500 I'm sorry, $6,700 credit against the position. So you're lowering your cost basis to $1,565. And so if your target is 115 and the stock stays at 105, 115 for August expiration, these two short calls expire worthless. Your 110 calls, I'm sorry, the 130 calls we looked at, no, they're 125. I'm sorry, folks. 125 calls expire worthless. You still got the 105 calls, and maybe you could add another butterfly to that as well. So, Clyde, I think in this position, what you're looking at is this is a possibility, you know, if you think it's going to be around 115. But remember, this management is probably going to have to be done in 2 steps. But no, it is a good idea. It is a concept we talked about briefly about rolling that position to the further out time. If you need to give yourself more time, just remember you're going to be adding some potential risk unless you get rid of half of those. Okay, so we could do that too. Remember, we sold half of the original, use some of the profit to buy 10 back in. We could just buy 5 of the 105s and then sell 10 and buy 5, and that might work for us as well. Okay. Well, ladies and gentlemen, I've taken up more time than I wanted to today, but I'm glad that we got to show that for Clyde as well for that scenario. But in any case, remember, how do you choose which one? It's about your outlook going forward, your personal risk tolerance, your time remaining to expiration, your level of trading approval as well. The preemptive moves, have your triggers set after the position is open. Okay, set contingent orders with your broker. Try not to take more of that 30 to 60 or 30 to 33% loss in your long options. You can use the power options portfolio to set those triggers as well. When considering management, reevaluate the underlying as you're entering a whole new position. Okay, you have to look at the expectation going forward. Does the adjustment that you think is going to work match? Don't trade against yourself. Okay, if the stock has fallen but you think it's going to recover and you do an adjustment that only benefits to the bearish side, and hurts you on the bullish side and your expectation is going to recover, don't do it for the sake of doing it. Make sure it matches your goals, okay? And when you're looking at the stock, when you're considering managing a long call or a long put, and you're considering laddering it by adding more calls after you sell half or something along those lines, would you enter this position today as a long call or a long put? If you look at the chart after it's happened and you say to yourself, well, I don't think it's still going to move up, I wouldn't enter it as a long call or as a long put today, then don't put yourself in a position where you're still trying to manage your long put by laddering it up to more long puts if you wouldn't have entered the long put today. And stick to the trading plan. It's very easy to think against ourselves. If we set our contingent to a 33% loss and we see a 38% loss like we saw in that one position in the portfolio, we say, you know what, it's going to come back. And then it becomes a 45% loss. And then it becomes, oh, it's got to come back. Does it? I mean, I've seen positions where I would have had a loss of 96% of my long call value in the first 5 days, not because of a gap, just because it gradually moved down in price about 50 cents to $1 per day on a $40 stock. 4 days later, I'm at a 90% loss. It could have closed it the second day after for only 30% loss. If you're in the situation, we didn't really talk about this, but Ernie and my philosophy here is if you're in a position that just unexpectedly moved against you, whether it was related to earnings or some news came out and the stock gapped down and you've got a 96%, 98% loss, it happened in the after hours where you couldn't do anything, hey, at some times, you just have to say, well, I've still got 3 months left. I'm at a 96% loss in the position. I could close it and take the loss, but hey, I've already got near 100% loss. Maybe I just leave this position open for now to see if it recovers and maybe do some adjustments, but say, can I get this down to where it's only a 70% loss or a 50% loss? That's terrible to say, but a 50% loss beats a 96% loss. So you may just want to leave it open and try to manage it just to get a little bit back. And a 75% loss sucks, but it's better than a 95% loss. Take it as you go. Don't panic. Okay, so, following the Hitchhiker's Guide to the Galaxy, bold words on the front, don't panic. You're in a position for 5 or 6 days, a long call or a long put. It's not going in your desired direction, or the stock underlying had a 5% loss, and you're looking at a 20 or 25% loss in your position. Don't panic. Still allow time for the stock to move in your desired direction. You don't want to be looking at your long call and selling half of it and rolling down today and then buying another 5 contracts 3 days later because it moved back up, and then selling half of those and buying 5 puts 5 days later because it started to move back down, and then closing those puts and then buying more calls. You don't want to be that active in it. Stick to the trading plan and allow yourself to move in your desired direction. And again, I can't emphasize this enough. Don't trade against yourself. Okay, if you've got a position, you were in a long put and the stock is gone up in price, your long put's losing value, you say, oh, I got to sell something real quick, I got to hedge this loss, I got to protect it, and you enter this adjustment very quickly to just try to hedge some of it. You sell a put right away, but then you realize that the way you did it is that if the stock keeps moving up in price, you're going to lose more in that direction. Don't trade against yourself. Okay, make sure that you set your expectations before you do the management, evaluate the stock, and think of what your expectations are going forward from here, rather than just panic selling an option to hedge the long call or trying to force a ratio spread or the credit spread at that time. Give it time to move in your desired direction. Don't panic, and don't ever do an adjustment that puts you in a worse scenario in the direction you think the stock's going to go. Okay, so questions? Well, please feel free to call us anytime. I'm not going to be available for the next 30 or 40 minutes or so, but you can contact us at any time. You can send us an email to support@powerop.com. You can also call us during market hours, of course, at 877-992-7971, or if you live outside the U.S., you can reach us at 302-992-7971. And again, we're having another webinar today at 4:30 p.m. and that's our open discussion presentation where I don't have any planned material. I just handle the questions on the fly. So if you're available at 4:30 this afternoon, go on ahead, go back to Power Options, register for that webinar there at 4:30 p.m. Eastern Time. You also probably got the email today where you can sign up for it, and you can bring your questions to that one as well. All right, well, I want to thank you all for joining me today. Clyde, thank you for your questions.